Let's move on to equities, gentlemen, because it's been an interesting start to the year. It's been a very nice rotation. Our 2025 theme was that we started the year saying that tech was a little overvalued. We felt the market felt very stagflationist and range bound. We got the tariff tantrum in April and May, and that opened up an opportunity to reposition the portfolios to add some tech. And then we really got focused on the whole deregulation thing, everything that Trump was doing around in a lot of areas of deregulation. So now as we go into 2026, the new, the equity themes are really that in the first quarter, we're going to see this continued rotation. And this is a healthy rotation. What's been happening is you have this little sell-off in the Mag 7, some of the leading technology names. But the money that seems to be coming out of NVIDIA and Microsoft and Apple and some of these names isn't going into cash. It seems to be rotating into healthcare, into financials, into basic materials, which is that shows great liquidity because people are taking money, they're taking profits, they're not sitting on it. They want to go earn something, so they're finding the next opportunity. So we've started to see some of the sectors in tech kind of lag a little bit, and then we've seen small caps, energy, utilities, healthcare, financials, and basic materials start to lead the market. And those areas of the market have been a while since they've been leaders. So what we think goes on next is that you get into the mid-year and a little more focus on the midterm. We get some volatility, maybe a correction. I don't see the next decline in the market a bear market. And that's what we have to avoid as investors. The number one thing we have to avoid is being invested during a bear market. Now, most bear markets, 90 or plus % of them, happen during recessions. So it's very rare that you get a bear market and not a recession. So if we can pay attention and see if a recession's coming, we can also avoid a bear market. Right now, when we look at our tea leaves, yeah, there's some things on the fringe, but they've been on the fringe for a while, and they don't seem to be growing into the middle of the pie. So I think if there's volatility or a decline coming up, it's probably a correction we should take advantage of and not the beginning of a bear market. And the one exception could be you get some weird black swan event, currency changes enough because of yen carry trade, and then something blows up, or a hedge fund that goes belly up and has to liquidate their portfolio, and you get a couple of days of volatility. So there could be something like that, but I don't think it morphs into a 1.5-year, 2-year negative market. And then I think as you get into the year end, typically in midterm years, you tend to get a little year-end rally. And I think overall, this whole year, the market broadens out. So I think overall, you want to be a diversified investor. You don't want to get too complacent, though, because if you look here, this is the S&P 500 over the last couple of years or year. And right here is this line is what I call the bull-bear line. And it kind of crossed over and crossed back up in the April tariff tantrum right here. And what's now happened is, while the market has kind of started to trade sideways since October with a slight grind up, we're kind of compressing into this trend line. So we're starting to get into a place that the market needs to either accelerate higher or it risks starting to break some trend lines. And why is that important? Well, it's important because a lot of algorithms, a lot of money managers use technical analysis. And so they're going to use this low point here back in the end of October as a pivot. And they're going to use this one here in November. And then, they're going to look at what's happening right now if this becomes a pivot back up. And all these are little data points in an algorithm that kind of determine whether the algorithm likes the momentum and the look of the market or not. And if you start to break below these trend lines, even if it's just a lackluster market, the algorithms all start triggering. That's how you get flash crashes and stuff like that. So, you can see here that it's a good time for investors to not be complacent, to be paying attention, because even though the market's not doing much, you're getting some trend lines that you got to pay closer attention. So this dotted trend line is what I would call like a short-term uber bullish line that we just touched in yesterday's market and bounced off of. And if we cross below, for risk management, people might want to start to adjust some of their equity portfolio. So for us, what I'm watching on the levels is my short-term Uber bull line. Like if this market just is supposed to keep powering higher, it really shouldn't break below 67, 6,800, which is the level we got into yesterday. Longer term, if you broke that level, I really wouldn't say the bull market is dead until we started to break below 6,500, which is not too far from here. And it's not like I would panic if we broke below 6,500. It just would be my first sign of, I better be managing risk. Where are my hedges? Do I have them? Where are they? Do I need to get them fast? So those are the levels that I'm watching to manage, because we've had a lot of growth the last few months that I do not want to give back. So that's what I'm watching. Reminder to everybody who's seen this before and hasn't seen it is that this is a chart from Jason Haver. He's a great chartist, great guy. He just was pointing this out a few months ago that, at these levels, the markets are at some unprecedented levels from trends. This is back at kind of the .com era here. So, you don't get up into these areas and fall asleep at the wheel. You want to be paying attention. Our barbell approach. So it's worked great. So what was that? So our barbell approach was, on one side, we had some old school names like energy, utilities, some traded REITs, some technology, materials, healthcare, financials. So we really kind of started with the first handful of those and then started adding them. And then on the other side of the barbell, we had some of the emerging technology, deregulation plays. Some of it was around crypto, like Coinbase and Robinhood, things like that. Some of it was fintech. Some of it was aerospace and AI-related names, quantum computing and energy. Well, since we did this chart, some things have changed, because in the middle of the barbell was our metals, gold, silver, and energy commodities. That stayed the same. But what's changed is right there. Traded REITs, we're not adding to those right now because our outlook on interest rates has changed slightly. So we've got some traded REITs in the portfolio. I'm okay with holding what we have, but I'm not adding money there right now until I get a better vision on the rate side. Our tech is not being added to. We have some names: Google, Amazon, ASML, some of the usual suspects, but they're in much smaller allocations than they were maybe 6 months ago. So that's why tech's in a little bit of a lighter blue. And then same thing in the world of crypto. There's a bill that should have been worked on and passed here in January that has now gotten political and is hung up. And so for names like Coinbase and Robinhood and Circle and Bullish, I've had to reduce some of our exposure there, because the catalyst I was looking for is now become political and kicked down the road. I still think the names in the sector are worthwhile long haul, but it's going to take longer than I originally anticipated. So we'd rather have the money somewhere else. And same thing with some of the AI and quantum computer names. This is just not the environment that the market is rewarding momentum or high risk names. So we've kept our allocation there small and appropriate, while we've kept our energy exposure and our healthcare and materials exposure and our metals exposure higher. And that's why when you look at your accounts, they look so good. So that's been the strategy. It's working. And you can kind of see how we've adjusted by the different color codings on this slide. So Justin, Patrick, first of all, are you guys happy? Are you happy? And second of all, what do you feel about the market? And while you're answering that, or if you have something more resourceful, these are the sectors that ended 2025 strong and are starting 2026 strong, and happen to be the more prominent sectors. If you look in your Goldman Sachs accounts and see your allocations, you'll see a lot of exposure to materials, energy, healthcare, utilities, energy, things of that nature. So who wants to take a crack at comment, question?
Well, we know Patrick's not happy.
I was just going to say I'm always happy. Smart ass.
I'd love to see that.
No,
All
not
right.
much has changed from a month ago when we kind of talked about this. Other
No.
than cycling out, just kind of paying attention because, like you said, we can't, all-time highs in the market. We can't be complacent.
No, I tell you what I've been disappointed with has been some of the names that I pointed out there. Some of the names I've been disappointed with have been in that crypto space and some of the tech stuff because they've gone sideways, and some of the stuff that surprised me that's done actually well before interest rates moved up. Like if you look at a chart of Annaly and AG&C and some of these things, they've defied gravity in the rate environment that's been there. So there's been some surprises too.
Yeah, I would point out that I read an interesting little bit this morning that, to your point at the very beginning, the Mag 7 has underperformed basically year to date, and that the Russell 2000 for 13, this is what they quoted, that for 13 straight sessions has outperformed the S&P, which I guess hasn't happened since 2008. So, kind of goes back to what you had mentioned regarding, just people broadening out their kind of the rotation of things, investing in different areas. Specifically, it seems like more small cap names versus some of these mega cap names, and divesting out of there. And probably, like you had mentioned, putting in or moving that capital from the Amazon, Apple, Google stuff into these smaller, small cap companies that are focused in the areas that we had just mentioned, or at least that are there on the screen.
Well, what's amazing is that how we've talked, and I've said to you guys, one of my great mentors always said, if you're in a really frisky bull market, but money managers are frisky when the market's being led by small caps and high yields. And if that's happening, then people are risk on. And it's been a long time. It's been years and years and years since we've seen that. And Justin, yesterday when you hit me up and the market had gapped down and you said, what do you think? Do you think the market's going to bounce? The first thing I did is I went and looked at the Russell 2000. And the Russell 2000's bounce was so much stronger than the S&P and the Dow. I was like, all right, well, that's a tell. And then we got into today, and the Russell 2000, and you could use JNK or HYG, any one of the high yield things. As of today, they totally recovered from yesterday's decline and then some, and that's an example of how they lead. Right? They went down and they let out of that boom, and they've already recovered. And that's been happening now for 3 months, since October, since the moment that the Mag 7, all those names started to go sideways. The small caps have gotten pep in their step. So it shows the liquidity, and it shows that you are in a bull market. Now, it also shows that you're not in the early stages, because this happens in the late stages of bull market, but it also happens in the parabolic moves of the market. So I don't think it pays to be negative when I see the market being led by small caps and high yields in my 25-year career. And the person who tipped their hat to me on that, I respect highly, and they've been right ever since. So that's what I'm seeing in the market.
One other thing too that I find interesting, like if you go back and you think about like at least the first part of last year, like last January, and you think about this January, like, all of the names that we talked about last year, just specifically on the equity side of things, you're really not hearing a lot of that chatter now. Like, and it kind of stopped there as we went into, the holiday season. But, last year there was just a lot of talk as we kind of led into 25, and then the first quarter of 25 of, AI, quantum computing. A lot of that stuff was just all in your face, all over the news. And obviously that continued throughout the year. But if you think about it this year, since the start, it's been pretty quiet, at least for some of those things. And there's been more talk and more rhetoric around some of the metals, which I know we're going to get into. And also, like we had just mentioned, the Mag 7 just really kind of, people taking money, taking profits and moving somewhere else. And it's just on like a, what just thinking about common sense type, like what was going on at the beginning of last year, just what you heard on the news and what everybody was, kind of talking about and chiming about.
You can see how the narrative changed, because the narrative changed from AI is great. Open AI and Microsoft and Google and Amazon and Nvidia, they're going to take over the world, and you better be careful. They're going to take your family, and humanoid robots are going to do everything, and we're all going to have universal income, and we won't ever have to work, but we'll have money. Right. You went from that to, oh, wait a second. Are these companies, or Oracle has spent too much, and OpenAI's made all these commitments and they can't come through? Is this all this revenue? And you started to have a 2000 moment, an Enron moment, where people were like, wait a second, let's look at everything that's been announced and everything everybody's saying they're doing, and let's work backwards to figure out, can they actually do what they do? Because you know what? People have caught on that, how do you know a CEO is lying? Shit, his lips are moving, right? So, most of these Wall Street analysts, they're making all these things. You're telling the press all these things, and because the CEO's telling you, and he's lying sack of shit. So, so now you've got the market at this level of expectation, and that narrative has changed. And as that's changed, you've seen this rotation in the market. And now you have some narratives even coming up that, hey, OpenAI and Sam Altman, that, they're falling apart. They're not going to be able to, they're going to be the next Enron, blah, blah, blah. Or, Nvidia has this, the storyline around it that, they're just selling chips internally in a circle of display of just, nothingness going in circles. So, so you've seen the market kind of calm down and investors get more discerning, which is good. It's actually, I think, good for the market to have a skepticism, because what you don't want in the market is, you don't want this parabolic move just to go, because then when it ends, it's over. I mean, it's when you get a parabolic move, it's over. It's not just over for a week or a month. It's fucking over, right? So you really want this thing to grind. So you do want a healthy skepticism, and you don't want the market to get too bullish. So that's why I say the trend is your friend, and we're in unprecedented territory. And there's two types of corrections. What we really want is the sideways grind correction that we've had for a little while here. But nonetheless, we don't want to get complacent, and small caps and high yields will be our early tell. When this market is done going up, they'll be the first ones to go down. But right now, the market's been broadening. Our barbell approach works. What we've got to do is just watch for the signs of exhaustion. And when we see them, we'll change and we'll report it to everybody. You guys good with that, or do you have anything else to add?
No, I'm good. Now we're on to the good stuff.
Medals.